Good day, ladies and gentlemen. My name is Rahul Advani, and I'm the Global Co-Head of Public Policy for Ripple, based in Singapore. It's very timely to be discussing the emerging stablecoin opportunity as we approach an inflection point for digital assets and their role in the global financial order. We gather today at a truly pivotal moment. The past decade laid the foundation for the digital asset economy. The next decade will determine whether we unlock its full potential. And at the center of this transformation are stablecoins. Stablecoins are no longer a niche experiment. They are rapidly becoming foundational to the future of finance. They are evolving into financial primitives, foundational infrastructure that supports everything from international payments and digital trade to asset tokenization and programmable money. The opportunities, particularly here in Korea and more broadly in the APAC region, are enormous. What I'd like to do today is to share some insights into why this moment matters, how the global stablecoin landscape is evolving, and how markets like Korea can take the lead in shaping the future of regulated digital finance. Let's begin by looking at the current landscape. The global stablecoin market has now surpassed $250 billion. That number alone is impressive. But what's more important is what lies beneath it. Real-world utility, not speculation. Stablecoins are evolving into critical infrastructure for a range of financial use cases, from cross-border payments to trading and lending, and increasingly, real-world asset tokenization. Take cross-border payments, for instance. Traditional correspondent banking is expensive, slow, and opaque. It often takes days to settle payments and comes with a tangle of intermediaries and high foreign exchange fees. Stablecoins offer a radically more efficient alternative. Transactions that clear in seconds with full transparency and no need for pre-funded accounts. Stablecoins enable transactions that are faster, cheaper, and more transparent than anything traditional rails can offer. They're already being used to settle payments in seconds across borders without the friction of intermediaries or pre-funded accounts. In trading and lending, stablecoins provide an on-chain collateral mechanism and a reliable settlement asset that is available 24/7. They're helping to build the connective tissue between fiat finance and the digital economy. This is the Internet of Value in action, and stablecoins are helping crypto and blockchain reach their TCP/IP moment. They're being embedded in the infrastructure, becoming invisible to the end user, but essential to how things move, essential components of modern financial infrastructure. At Ripple, we've seen this firsthand. Ripple has used stablecoins in our payment flow for years, so we saw an immediate demand in our business for a safe, compliant, and global stablecoin that would appeal to an enterprise audience. That's why we launched Ripple USD or RLUSD at the tail end of last year. In just under 6 months, RLUSD has surpassed USD 300 million in market cap and more than $10 billion in trading volume. RLUSD is fully compliant. It's issued under a New York Trust Company charter, which offers bank-level oversight and protections. It's designed for enterprise utility. It's integrated directly into Ripple payments. And finally, it's built for scale with transparency and regulatory oversight from day one. And this is already being used in production, especially here in Asia. Ripple customers like BKK Forex and iSend are using RLUSD to improve cross-border treasury operations. This isn't theoretical. It's happening today and at scale. However, an important element for adoption of new technologies, such as stablecoins, is regulatory clarity. And jurisdictions in Asia are also leading the way in shaping the regulatory landscape for these new forms of digital money. Of course, with any new technology, utility alone is not enough. To fully unlock the potential of stablecoins, regulation must evolve alongside the innovation. Today's regulatory environment is still fragmented. Some jurisdictions have embraced innovation, while others remain cautious. But this fragmentation presents both a challenge and an opportunity. Jurisdictions that get it right with clear, proportionate, and forward-looking frameworks can attract capital, talent, innovation, and institutional participation. So why is that? Well, because stablecoins sit at the intersection of financial services and blockchain innovation, they are a fundamental building block for digital asset markets, payment networks, and real-world asset tokenization. But for stablecoins to deliver on their promise, we need regulatory clarity. That means clear definitions of what a stablecoin is and what it isn't, strong reserve transparency and auditability, cross-border coordination to avoid regulatory arbitrage and preserve the global fungibility of stablecoins, and most importantly, public-private collaboration to ensure frameworks are grounded in real-world use cases. Let's take the concept of fungibility. One of blockchain's greatest strengths is its borderless nature, the ability to move value anywhere in the world instantly. But when we require local issuance or siloed structures, we risk fragmenting the very systems that stablecoins are meant to improve. Fungibility isn't just a feature, it's foundational. Fragmented networks reduce efficiency, increase costs, and limit scale. There are some positive examples in the region that we can build on. In Singapore, the Monetary Authority of Singapore has taken a measured but innovation-friendly approach to regulating stablecoins, issuing clear guidance for single currency stablecoins, or SCS, issued in Singapore, but not restricting the use of other stablecoins. We expect to see draft legislation later this year. In Hong Kong, the Hong Kong Monetary Authority has created a sandbox for stablecoin issuers, which allows issuers to experiment in a controlled environment, with regulatory oversight until regulations for fiat reference stablecoins, or FRS, are issued. The stablecoin bill passed in the Legislative Council last week, and we expect to see final legislation by the end of this year. While in the UAE, regulators have introduced frameworks that support both fiat-backed stablecoins and tokenized assets with an eye towards interoperability. At Ripple, we don't see regulation as a barrier. It's a catalyst. Regulation is a clear differentiator that enables global financial institutions and enterprises to embrace digital assets, delivering real-world economic benefits and utility. RLUSD is proof that compliance and innovation are not mutually exclusive. They are mutually reinforcing. It's very simple. Institutional adoption won't happen without trust, and trust starts with regulation. This brings us to what I believe is one of the most promising frontiers in digital finance, tokenized real-world assets, or RWAs. Recent research by Ripple and BCG projects that the market for tokenized RWAs will grow from approximately 0.6 trillion today to nearly 19 trillion by 2033, a staggering compounded annual growth rate of 53%. That includes everything from tokenized commodities and treasuries to real estate and private credit. In short, the digitization of the global economy. Stablecoins play a critical supporting role in this evolution. They serve as collateral for on-chain trading of tokenized assets. They also serve as settlement assets for real-time clearing of tokenized transactions. And finally, they act as liquidity bridges between fiat systems and blockchain networks. We're already seeing institutional demand for this. Ripple's partners are asking for stablecoins that are compliant and trustworthy, that are interoperable across markets, and that are available 24/7 to match the pace of global capital markets. RLUSD was designed precisely for this purpose. It enables near instant settlement, reduces the need for pre-funded accounts or FX buffers, and increases transparency in capital flows, all while maintaining full regulatory compliance. This is how we make tokenized finance work at scale, with stablecoins as the infrastructure layer, bridging legacy systems and next-generation rails. To close, the rails of traditional finance weren't built for the real-time global economy that we operate in today. But we're not here to tear them down. We're here to modernize them, and to do so in a way that's responsible, transparent, and inclusive. Stablecoins are that bridge. They bring the speed and efficiency of digital innovation together with the trust and oversight of regulated finance. With the right regulatory frameworks in place, that is, if we enable regulatory clarity, which allows institutions to participate with confidence, then stablecoins have the potential to evolve from a complementary innovation into a foundational component of the future financial system. Thank you again for the opportunity to speak today. I look forward to continuing this important conversation.